Boeing has been one of the dog stocks of the last few years. They've had a lot of problems, a lot of issues.
We'll cover today whether or not you should want to be buying Boeing stock or might want to look somewhere else in the defense industry. And also, we do a 3-minute drill on a company our subscribers asked us to look at, Spectrum Brands. Tune in today for Altimetry Authority. Let's talk earnings and
The GAAP accounting.
favorite pastime.
So let me just say, earnings,
Liquidity
by the way,
Wall Street
I think
has
is why do they
2.5x
do it? Because their compensation goes up.
Wall Street's wrong again. Earlier this fall, Boeing was in the news because everybody is finally saying, is Boeing out of the woods? Boeing is talking about finally ramping up 737. For those of you who've been following this narrative, you know everyone from 2019 with the issues 737, and then we had issues with 787, and then we've had more issues in terms of crashes, issues with safety and everything else. But everybody's saying, hey, Boeing's finally ramping back up in terms of their 737 output. They look like they fixed all the issues. They bought Spirit, which was one of their suppliers, to be able to fix what they were seeing in their supply chain. They've worked with other members of their supply chain. They've worked with the FAA. They've worked with everybody. We're finally putting it behind us, and there might be an opportunity. And this is what the stock market is showing you too. I mean, the stock's literally up 50% plus in give or take 50% in the last year. That's really showing you we are seeing a recovery. But the real question is this actually the news that you buy? Or is this the news that tells you that the market already knows the narrative? And that is what our goal is here as we try to set the line here with the altimeter. Let's dig in, Joel, in terms of what it is that's really going on for Boeing and if there's an opportunity here or not.
All right, so what you're looking at are the orange bars. The orange is a warning. It's a warning sign. These are the GAAP, generally accepted accounting principles, the as-reported numbers that Boeing produces that they're required to by the SEC under the rules that are designated by the the FASB, which the accountants create these rules. Now, we don't believe that the rules reflect economic reality. We don't believe that they're finance. No good investor ever believes that GAAP accounting reflects reality. And here's reality, which is, in many of these years, their returns are actually much worse, other than in 2023, where maybe their returns are slightly better. But I mean, 0 versus 1% doesn't make a lot of headline. But in the other years, they really have produced a far worse return than their GAAP accounting numbers would suggest. Now, when we get rid of the orange bars, because you would never base your valuation on those, you see the blue, that's the economic reality. And when you see the shaded blue, lighter shaded blue, that's because we're saying, all right, here are the forecasts. Now, 2025 already includes whatever 10Qs have come out. And then we supplant that with whatever Wall Street's aggregate pro forma line-by-line financials say. We put it all together, and we say, so this is not someone at Altimetry making these forecasts. We're saying Wall Street in general sees this company's returns popping right back to around 7.5%. Now, U.S. corporate average is still 12 to 14. All right, global corporate average is around 6. So they're saying, hey, this is getting back to some level of decency in terms of profitability. Nothing fantastic, but that is still a big recovery from 2024's, more than negative 10% return on assets. Now, what is the market embedding? And this is the important thing. Embedded expectations, we're setting the line. We're not telling you it's overvalued right now. We're not telling you it's undervalued. We're simply saying to get to this price, right, as your bookie, we're telling you here's the over-under. And the over-under is for this company to justify, right, $96 a share and about a $149 billion market cap. To get to that, returns not only have to get back to 6 or 7% that Wall Street kind of believes, but they have to get back to U.S. corporate average of around 12 or 13%. And then hold that forever. That has to go on in perpetuity. That is the line that's being set. So the question is a rebound expected for Boeing? Wall Street certainly thinks so, and the market is looking even past Wall Street's lofty recovery into this company's right back center U.S. corporate average returns, which are double global average returns, despite having a lot of other global airlines out there like Airbus to have to compete with. And they're saying, no, you're going to have better than global average returns. That's what's priced in. So now the question is, if you think that Boeing can do it, do this performance level, there's no reason to buy the stock because it's already priced in. You'd have to buy the stock. You have to believe that they're not going to just get to this, but they're going to get to a 15 to 20% return, that they're going to be more like a Coca-Cola. And by the way, and hold that level in perpetuity. Because if it doesn't hold in perpetuity and just cycles back down again, well, then you wouldn't count it, right? And so what you're looking at is if you think it's at this level or anything lower, then you ought to be selling the stock. That's the over-under.
And so everybody, to put that in perspective, exactly what Joel said, now you might look at the fact that we're showing you 5 years of history here and go, well, hold on. Those are literally the 5 worst years of Boeing's history over the last 40 years. What does Boeing look like when it's a normal operating business? Well, we have that data and we can look at it. And what we can see is when you look at Boeing's return on assets over the last 20 years, and really, if you want to look at Boeing's return on assets and profitability, you really shouldn't worry about anything before 1998, 2000, because 2 really important things happened in that period. One, they got McDonnell Douglas. Yeah, exactly. They got McDonnell Douglas, and they basically became a purely duopoly with Airbus because once they acquired McDonnell Douglas, there was no other U.S. manufacturer of commercial aircraft for other than regional jets, which is Bombardier and Embraer, which aren't even American for what it's worth. But 2 is they and Airbus in the early 2000s got religion about not living by the boom and bust cycle of airlines. Where what they did is they basically said, hey, airlines, you might want a lot of aircraft. We're going to make this many aircraft and you're going to get in line. So we're going to have an 8 to a 10-year order book so we have visibility on cash flows. So they basically said, look, we're just going to steadily increase the number of aircraft we build and we're going to be able to have visibility. Well, in that period of time, return on assets averaged between 8% to 12% a year. Their best years in the best setup they could ever have, which is a boom time of China buying their aircraft, steady demand growth, steady production growth, really good operations in the early 2010s and before that, they only had a 12% return on assets, and that was the best years. Most of those years, they sat around 8 to 10. And so when you look at what the market's pricing in right now, to Joel's point, there's just a real reason to say, hey, look, this does not make sense. And why it's laughable when we look at this chart. Because what this chart shows you, those blue lines, those blue dots at the very, very edge here, those blue dots are what Wall Street analyst target prices are for Boeing. And all of them are above this stock price, which shows you that all of them think that Boeing is a buy, which just shows you Wall Street does not know how to value stocks, and you should not listen to Wall Street's valuation and their price targets. Listen to what they have for forecasts for companies because they actually do know how to forecast a company's cash flows because they're so close to the company and so close to the channel checks. But do not listen to their stock prices because their target prices make no sense right now. So if you don't want to buy Boeing, though, there is one other company that we do think looks interesting. And Joel, you want to just walk everybody through what we're seeing for General Dynamics before I give everybody a little context about why this one might look interesting?
I mean, it's a totally different return profile. This company has had 15 to 20% return on assets improving over that time frame from 2020 to 2024. Wall Street analysts, when they look at General Dynamics, GD, are that they're going to continue to have these high-level returns, this high platform that they've achieved in the last couple of years, that they're not cycling back down. And yet the stock market in all this is saying, all right, we believe that Wall Street trend will continue, and they kind of flatten out at 23% returns in perpetuity. In perpetuity. That's what's priced in at this stage.
And so if you look at it, you might say, hey, look, but these are still, remember when we talk about setting the line, the best lines that we like to see if we want to bet on a stock is for the ROA, the white bars, to be below the blue bars. But even this one, everybody looks interesting because unlike Boeing, General Dynamics has a lot of good things going for it. So General Dynamics, they have they make ships for the U.S. government, right? They basically Bath Iron Works. They make everything from subs to cruisers to they help with the carriers and everything else. And they also have a very, very big cyber part of their business from a defense contractor perspective. Both those areas are areas the U.S. government is prioritizing right now. And then the other interesting thing about General Dynamics is it has another third part of its business, which is called Gulfstream. And what Gulfstream is Gulfstream makes PJs. They make private jets, the best private jets. We are in the middle of a tech boom cycle. And do you know what happens when tech CEOs make a lot of money? They want to buy private jets. So we've got a potential boom cycle for Gulfstream coming up here. Well, General Dynamics has a bunch of money being poured into its two biggest parts of its defense market, its defense industry exposure, unlike Boeing, which is struggling in terms of commercial aircraft, and also, quite frankly, where Boeing is exposed in the defense industry, it's not doing nearly as well. So General Dynamics, to everybody, looks to us like one that if you thought you want to look at Boeing, maybe poke around General Dynamics instead. It might be interesting. So that covers the companies that we really want to cover today. But we did have a request from one of our viewers. One of our viewers asked us to do a 3-minute drill on Spectrum Brands. And so Joel, you always love to talk about the idea of let's set the line. Let's set the line on what's going on with Spectrum Brands, and then we can paint the fundamentals over top of it once we know what the market's thinking.
So in economic reality, they had a couple of good years in 2020 and 2021. Spectrum Brands is Black & Decker. Spectrum Brands is Remington. A lot of garden care products that you would know. You would know Spectrum Brands went by their brands, not by the company name necessarily. And they had a good 2020, 21. They did not have a good 22 or 23. They've rebounded into 24. Wall Street analysts, right, and the latest 10Qs suggest that 24 is sort of the benchmark year that they can kind of hold with some volatility around that level. And then the stock market is saying that over time, it's going to fall back down to like a 6% return level, especially given how volatile they've been in the past, meaning why wouldn't you? And 6% says they could still be cyclical, but they'll cycle around a 6% return, which is the global corporate average. U.S. corporate average is 12 to 14%. And so what's buried in a Spectrum is not a lot of lofty expectations for the future. It's something, a little bit less.
And so everybody, the reason why this could look interesting, right? This is not a stock that we recommend, but right, for the viewer who asked for it, is when you look at that ROA decline that they had through 2023, that was because of two businesses that they either have already divested or they're in the midst of divesting. So this company used to have three big parts. It used to have pets and garden, which we talked about. It had hardware, and it also had appliances, right? Joel, to your point, Black & Decker, Remington appliances. For pet care and for home, you're talking about Cutter, you're talking about Nature's Miracle, and then they had various hardware. Well, the hardware business really, really struggled. They already sold that business. So that business they sold back a year or two ago, that actually helped explain a lot of the return decline, was that business struggling. They're also spinning out the appliance business, the Black & Deckers, the Remingtons of the world. And that leaves them with the garden and pet businesses. And if you look at the garden and pet businesses, those are, if you do comps, businesses that actually have very, very good return on assets. Those businesses, because pets are something people are willing to spend on, and garden is a very easy, low-cost discretionary opportunity. You generally see return on assets for those businesses, if you look at a Scott's Miracle-Gro or anybody else, that trend above 10 to 12%. And so this one really actually might be interesting, everyone, because of the fact that the market is pricing this for the issues that the company had, not for the company that's left over afterwards. And so everybody, if you have a company that you want us to look at for a 3-minute drill like we just did for Spectrum, feel free to drop them into the comments, or if you have another defense company you want us to look at also, and hit the like and subscribe button and come back for the next time. That's this episode of Altimetry Authority. Thanks, everybody.